If you have $100,000 sitting in a bank account, the instinct to leave it there is understandable. It is safe, accessible, and simple. But once your short-term needs are covered, idle cash starts losing value to inflation. That is where the bank versus brokerage question becomes worth thinking through more seriously. The core difference comes down to what you need each dollar to do. A bank account is built for stability, immediate access, and protection. Eligible deposits at FDIC-insured banks are protected against bank failure, subject to certain limits. The liquidity can be essentially instant. The trade-off is that returns are often lower, even with a high-yield savings account. A brokerage account is built for long-term investing with the potential for growth. You're investing in ETFs, stocks, and other market assets in pursuit of higher long-term returns. While you still have a level of protection against broker failure, you're not protected against market losses. If you need liquidity, it typically takes 1 to 2 business days to settle, depending on timing and processing factors, and there's no guarantee on returns. Bank accounts protect what you have. Brokerage accounts give you the potential to grow. 4 factors help determine how to split the money. The first is liquidity. If you expect to need the funds soon for things like taxes or living expenses, that portion should be kept in a bank account. Funds you likely won't need in the next 6 to 12 months may be better off in a brokerage account, where they can often work for you. The second factor is risk tolerance. Would a market dip impact your short-term needs or goals? If so, keeping more in cash has real value beyond just the numbers. The third factor is how you want to manage it. Bank-heavy allocations tend to be simpler and more predictable. Brokerage allocations often involve some decisions, although there are options to streamline and automate. The final thing to keep in mind is taxes. Bank interest is taxed as ordinary income. Investment gains held long enough may qualify for lower long-term capital gains rates, allowing you to keep more of what you've grown. And remember, it's not all or nothing. You can split your funds between accounts in whatever way works best for your personal situation. Shorter-term needs in the bank, longer-term savings in a brokerage. A more conservative approach would hold the majority of your cash in the bank, and a more aggressive split would have more money in the brokerage in hopes of higher returns. The right mix adapts to your income stability, your goals, and how much short-term uncertainty you can absorb. Mercury Personal brings banking and investing into a single platform, removing the friction of managing multiple apps. It includes checking and savings accounts and investing options directly within the same dashboard. You can earn interest on savings accounts with no minimum balance requirements, set automatic transfer rules between accounts, and move access funds into a higher yield savings or investments without switching tools. For a more detailed breakdown of allocation options between bank and brokerage accounts, check out the blog linked in the description. And if this video was helpful, make sure to like and subscribe.